We have with us Nithya Easwaran, Managing Director at Multiples Alternate Asset Management. Nithya heads the financial services business at Multiples PE. Welcome to ET Now, Nithya.
Thank you, Anurag.
So, in the past 10 to 12 years, India has seen a fair share of local homegrown private equity firms emerging. How do you differentiate yourself from the peers, and how would you define your investment strategy? Anything that's unique about you?
I would like to say that Multiples has been born with an entrepreneurial DNA. And what do I mean by this? We do three things very well. First is identify the big shifts that are happening in each vintage. So for each fund, that's an outlook that we create of identifying the big shifts. Second, look for entrepreneurs who can play these shifts well. And here we bring together an art and science of this. One would imagine that when you're selecting an entrepreneur, it's a bit of a art, but we have created a science around it where we have our own framework to evaluate entrepreneurs. We call it an LEL framework, and try to match the characteristics and the personality of the entrepreneur, the strengths, to the journey that they're going to take to play these shifts. And third, together, Multiples and the entrepreneur together, we seek to power new possibilities. And what do I mean by that is what individually either of us couldn't have done alone. I think the power of the two of us coming together in tandem really creates those opportunities. So while it's normal to define a private equity investing business more in terms of sectors and themes we'll play, and of course we'll talk about that in our conversation today. But I would say that one defining factor is the entrepreneurial DNA. We feel businesses like the entrepreneur, and the management feels the business, and we stand together with them to create this unique journey.
Multiples Private Equity and Advent International. Recently, you've invested in Ananya Birla's Swatantra Microfin. Elaborate on the deal and give us an idea what kind of stakes both of you have individually picked up. And broadly, what's the investing strategy in Microfin?
No, this is a very unique deal, Anurag. I'm so delighted to have been partnering Ms. Birla and the team at Swatantra, because this brings together two very powerful platforms, Swatantra and Chaitanya. Not only will this be a play of scale, because it's also diversification, because they had complementary networks, geographical networks. And we do know that when you're funding people at that strata of society, and it's good to have a very diversified play that gives stability to the institution. Also brings best-in-class credit performance that Chaitanya had, with very good technology, analytics and network that Swatantra had. So really we see this coming together, making Swatantra, version 2 of Swatantra, to be a very powerful, large institution in the country. Happy to be part of that journey. As you know, the deal is still under regulatory approval, so I'm not going to comment on the stakes. But it will be a majority owned by Ms. Birla. Both Advent and us together will partner as minority partners and take this journey forward.
PE and venture capital investments in India moderated in 2023, especially led by some sectors like technology, e-commerce. That had slowed down the pace, but there were some other industries, including financial services, which you manage, which were holding out, during this slowdown phase. In this year, which are the industries you think have a promise of growth and could actually support private equity investments into India?
No, I'll just take a second to, if we look back, and if we look back 2013 to 2023, right, we'll really see the trend. We had a very big blip in 2021. So I like to look at these in averages. So if you see 2021 to 2023, on an average, about $48 billion of investment went into private equity. If you just wind that back to say what was the 3-year average in 2013, that number would have been 8 or 9 billion. So we have come a long way. And we will see some of these peaks and and troughs coming in. But I would say, just in terms of absorptive capacity of India into private equity, has really stepped up very significantly. Now, in this, I do believe that from, as you rightly pointed out, some of the sectors which continue to do well, I would add pharma healthcare to it as well. I would continue to add IT services to it. So in multiples, we have looked at it as a matrix of 4 or 5 industries where we have done deep work and certain investing themes. So, consumer continues to be interesting. It's of course been a kind of a different year with inflation playing out at certain segments of consumer, but you see the affluent Indian consumer really stepping out now. And I see that trend continuing. Now, to play to this affluent Indian consumer, you will have categories like travel, you will have categories, even parts of healthcare, diagnostics, as people pay attention to their health a lot more. You would have financial services playing to it in terms of personal loans, asset management, credit cards playing to the affluent Indian consumer. So that is a secular trend as I see. The other secular trend is India manufacturing, which is different from before. And we see both manufacturing India for India and India for the world, both playing up, and it's coming with a lot of the government attention also to it. So I would call out some of these themes along with financial services, because the penetration story, both in the, to the SENP as we call it, self-employed, non-professional, universe that is there, that continues. So MSME lending, affordable housing finance would also continue to be large spaces that we'll look at.
Affordable housing, is that a sector that has a lot of promise in India?
Yeah. The affordable, housing finance segment, where there are people either building their own homes or buying smaller apartments. And in the tier 2, tier 3 cities of India is a very large segment. As you know, we in multiples, we set up a platform back in 2015. We partnered with a very entrepreneurial management team and set up this company called Vastu Housing Finance. Very, very proud of that investment. That company is now about 9,000 crores in AUM, built with a top-class, tech-led, approach that they have brought to this very touch-and-feel segment. A fantastic company. So we will continue to see a place like that going forward. Even in, if you take the MSME segment, we have had 2 plays there. One through another platform, which we partnered Gunit Chadda when he set up APAC. They are growing well, and recently invested in Veritas, another wonderful company which originated from the south. And they are building out the small ticket secured MSME segment. So it's something that we truly believe in, and I think we'll see a lot more companies, really scaling up now. All of these companies now, Veritas would be close to a 5,000 crores AUM company. We have another company called Kokta, which is in the commercial vehicle financing space. So both vehicle financing as well as MSME as a combination. So all of these, if you put it all together, actually you'll see a very large footprint for multiples funded companies in this whole space.
You also have many financial industry investments, companies in the financial sector. Now, off late, and mostly they're lenders with a retail focus, strong retail focus. Now, recently, RBI has tightened its grip. It's got tighter regulation on NBFCs, on retail lending particularly. How does that impact your investment decision? And what are the kind of lenders multiples will be looking to partner?
Yeah. See, we've had a very stable, largely stable financial services ecosystem, and I think we have to thank our regulator for that in terms of, and all the institutions like the credit bureaus and all the data that's kind of coming in, which is allowing all of us to assess where the credit excesses are happening, if any, in the ecosystem, and allowing us to correct. In all our companies, one of the things we over-index on is risk management and quality of customer that you're onboarding. So, and that is key because the journey that we are playing is to create, the premise for what I tell to all our businesses is to say we are investing in very promising businesses and we want to build them to be premier institutions. Now, if you want to institutionalize, you will have to calibrate the growth and the risk. Now, what are some of the things that is becoming very important now, right? People are talking about diversification of liabilities. Very, very important from a risk management perspective. Or the fact that, you have to, improve your compliance as you're institutionalizing, or being fair to customer. I think these are excellent foundations to create in companies, and we have always been emphasizing on this, both through board processes as well as bringing in the right people in the companies, because this is a leverage play, and I think we should recognize that. Also, we are dealing with customers who are in the tier 2, tier 3 cities, so it's important that in terms of fairness, in terms of disclosures to them, and the way they are treated, that it should be appropriate. So all of these, if you have all of these foundations, then we will see through these cycles. And I think the regulations are also thereby in the right direction into these. So as companies build up, go over the rating scale, attract different kind of liabilities from banks, from mutual funds, through bonds, through securitization and direct assignments. That is what will help them scale this up.
Right. So the pace of disintermediation and digitalization in India is growing exponentially. You can say it's growing leap and bounds. Okay, that's also given rise to fintechs. Okay, they're also growing, and some have been predicting. I mean, analysts and the bankers have been predicting that fintechs, India may be the biggest fintech market in the world. What is your stance on investing in fintechs, and how would you orient your investments towards this industry, this fledgling industry?
Yeah, it's been a very exciting time the last few years in terms of adoption of digital in financial services. So we've been also thereby looking at it with great interest. I've always considered fintechs to be a continuum. This financial services and fintechs is actually in a way a continuum. And I've also preferred companies which play, in the center of regulation always, rather than being on the fringes and then, interacting with regulatory entities. Because if you are talking to customers and if you're talking to regulated agencies on the, entities on the other side, you're very much you have to adopt practices which are thereby appropriate for that role which you play. So we look for entrepreneurs which are, which bring a good background of financial services combined with technology. Where are they? Why do we need these fintechs, right? What are they really bringing? One is great customer experience, which allows thereby more inclusion, and you are able to take products which are smaller sized to the customer, bite size, which a traditional distribution system may not allow you to take. And that's where, that's their USP. What the banks and other financial services companies bring is good risk management practices, great balance sheets, good capital, and thereby a combination of these two is best for the customer. So we've had some excellent investments. We've invested in ACO. It's an insurance company, but a tech-first insurance companies, and some of what they are able to do, it's difficult to do without technology. For example, one of the most exciting things about ACO is that their first notice of loss is close to 70%. What this means is if there is an incident with your car, who do you call? The dealer or the company? And who you call determines the quality of experience you will have in the claims, determines the intensity of claims for the insurance company. And to have, a industry leading 70% plus FNOL is unheard of. It's at least 20 percentage points higher than the traditional insurance sector. Because it's an app-led digital first company, ACO is able to do that. And that allows them to, get great quality customers and provide a very good experience. So we'll continue to look for these places. I think some of the places where fintechs will play a very interesting role is also in addressing affluent India with products, whether it's in wealth management. Because you have seen the HNI India being addressed through the classical wealth management companies. But there is a whole affluent India where you will have a phygital approach. So some of those would become very, very interesting. And even in the classical sector, so let's say a supply chain finance company with a good dose of of digital-led, technology-led innovation will allow this sector to do well.
All right. So within the financial sector, are there any subsets which are particularly attracting a great deal of interest from PE investors, especially global PE firms? And are there any potential candidates right now in your sector that you're currently in talks with to invest?
We always have a pipeline, Anurag, which is live and kicking. So at any point in time, we would at least have 7 or 8 companies that we are evaluating in financial services alone. So yes, we are very much active. We are in our 4th fund now. In the last 3 years, 2021 to 2024, we have put out about $400 million in financial services alone. And I have gone out and actually said I want to put $500 million in the next 3 years. So we will be very active in the investing front. The 2-3 segments which I spoke about, which is the MSME sector, both the small ticket MSME as well as supply chain finance will continue to attract us. Affordable housing finance we spoke about a bit. Consumer financing. We are seeing both credit cards, personal loans. A lot of chatter around it, but I do believe there will be some breakout stories here. Education finance will be of interest. Asset and wealth management to affluent India, as well as insurance, health insurance. All of these play to the increasing affluence of India and people paying attention to their to the financial products that they want to consume.
Yeah, so PE exits in 2023 saw a surge. If I may quote a recent IVCA EY report, I mean, that put the number at 36% increase in PE exits. So do you think that it's a right time for PEs to exit some of the older investments, I mean, at multiples and broadly, PE as an industry?
Absolutely. There are 2 things that are happening. One is IPO markets. Last 2-3 years, they've been buoyant, and that's great. And I can see that there's a lot of acceptance of PE-led companies accessing capital from the IPO markets, which is great. The second is the entire ecosystem has built out, right from seed, to VCs, to growth Ps to buyouts. And a large part of exits we'll also see coming from there as companies take their different journeys before they get to the capital markets totally. So both of these are great news. I spoke a little while before about how $48 billion is the average investment that is going into PE. If you see it on exits, it's about 25 billion, which is fantastic news.
Right.
And that stepped up 5 times from about a decade ago. So it multiples what we try to keep we are very agile on our exits. We also take periodic exits from our companies and don't bunch it up at the end. So our aim is to say that with an average maturity of 4 years, we want to return principal to our investors. So with that in mind, we are, I would say, always looking for exits for some of our older investments. So you would see some of our in Fund 2 investments would be on the exit zone. We've been on the exit zone on it, and we'll continue to do that, both through P2P as well as capital markets. It's also capital markets. Taking company to capital market is a journey. You have to prepare the company, and it's not just size. You have to be prepared in all ways, so that the scrutiny of the public markets is harsh. You have to live up to the disclosure standards, compliance standards, and everything that a capital market investor desires. And so it's a journey. We will take our companies there. But yes, you would see exits coming in the next few years, especially from some of our Fund 2 investments.
Super. You've been on the boards of many companies in your capacity as somebody who's worked in multiples private equity. How do you see the change in India INC in the company? Generally, if you just take the companies you have served on the boards as a yardstick, is there an improvement in corporate governance standard? Is it becoming more stringent now, and are rules being followed more thoroughly? And also importantly, has transparency improved?
Yeah, I would say unequivocally yes, definitely so. Also, companies, as they scale, they realize the importance of the role played by the boards, right? It is, in fact, I would say a good protective layer for managements, because a person who is equally interested in the company but sitting a little distance away from the management is able to give a much more holistic view, and also stand up for the company in times of need and distress. So I do see that engagement changing very significantly. One of the roles that we choose to play, especially in younger companies, is to bring this awareness early. So we have built out a team within multiples, of compliance, legal, what we call as our fitness team, who engages with with their counterparts in our portfolio companies to set this up. Because when you're young, you want your company to be agile, and it's a small company, it's a young company, and the founders are intimately involved. And as it scales up, you have a lot more to lose if you get it wrong, right? And that's when the board's involvement becomes very, very critical. So I do see not only shareholder board members, but also a lot more acceptance of independent board members. So the good news about the sector that I play in is even the regulators, require, as your scale goes up, your board composition to be of a certain level, and and to perform the right committees and to debate. So I do see that that playing out very, very well, not only in some of the larger companies that we have invested in. So companies like in the TI Clean, where it's a great example of where you remember I was speaking to you about entrepreneurial DNA and backing the right entrepreneur. So we have backed SWLN to build out OEM in the electric commercial vehicle space. So larger companies like that bring the DNA of the governance from their parent, but even the younger companies are, I would say, adopting it, and especially in the companies where they are coming out of the VC world into the PE world, we see our role as important in making that transformation.
And what advice would you give people, young people who are looking to join the PE industry? What qualities, according to you, they need to have to make a mark here?
Yeah. See, first of all, I think we need to redefine PE. So PE, people think of it as an investment firm. I really think PE is the next economic owner of India. We had, promoters who were owners of businesses. Now we have economic owners, which PE increasingly, you're finding a lot more controlled transactions as well, and cap tables have a lot more PEs, and you have the managements. So when you think of a career in PE, there are many shades to it. One is the investing as an investment professional. It's a wonderful career. I've never seen another where you can have the breadth and as well as the depth of understanding of industries. Here, I would say the characteristic is one of extreme diligence, great curiosity, and ability to live with ambiguity as defining characteristics. Because every time we make an investment, despite all our Excel sheets and everything that we may project, we are taking a little bit of a leap into the unknown as to what the journey will be going forward. And as we partner companies and live through the post-investment phase, we have to take the volatility of the markets along with us and build the companies. But more interestingly, beyond the investing professional, we have a lot more people who engage with us as we build companies. I was speaking to you about our fitness team. So we have wonderful professionals in legal, compliance, accounting, who work with us closely on diligence and reporting of our portfolio companies. We would have experts, industry experts, join us as we create value and transform our portfolio companies as well. So these could be people. We have had a wonderful professional, a global professional called Aaron Tas join us. He's joined the board of Quantify as well, as we built that AI company, up and in partnership with the founders. So Aaron, for example, had a career which was with emphasis with Philips globally, and these are kind of professionals who can come and work along with portfolio companies to really bring value to the companies. And so you could engage with this industry in many different ways.
Nithya, it was nice having you on ET Now. Thanks for speaking to us.
Thank you so much, Anurag. Wonderful speaking to you as well. Thank you.
Thank you.